Welcome to Stock Talk with Nico Kritikos. Today, we're going to be going over Adobe stock and doing an in-depth analysis on this company. If you don't know, Adobe is one of the world's largest software companies, and their products and services are primarily used by content creators and people that do photography, video editing, and stuff like that. They have Adobe Illustrator, they have Photoshop, Premiere Pro, different things like that. Okay, so last year this stock topped out at around $700 a share. Today it's only $430, so it's definitely come down a lot. And so that brings us to our first point, which is number one is going to get a yes because the stock's down over 30%. Really quick, it looks like their two biggest sources of the revenue based off of what it says in the I read the quarterly report. The Creative Cloud is one of their biggest sources of revenue that contributed $2.5 billion in 2022, and digital media contributed $3 billion in 2022. Their most recent quarter saw $4.2 billion of revenue, and $4 billion was from subscription services. So those subscription services is really how they make their money. Then we have is revenue and net income increasing, and if we go right here, we could see that, yes, it's definitely been increasing. I believe over the past year, net income was down a little bit. See, 2020, because 2020 was the year everyone was at home, and they probably got a lot of people signing up and buying their products. So they did $5.2 billion of net income. Then last year, they did $4.8 billion. So a small decrease, but still, that's a huge amount of money they're bringing in. However, revenue still climbed. So revenue was $15.7 billion in 2021. Therefore, both of those metrics will get a yes, right? Then we have a healthy price to sales, and their 2022 price to sales is an 11 with 13% growth expected. This is where it gets interesting. So it looks like Adobe is one of those companies where they will just normally trade at such a rich valuation that they're always going to look somewhat overvalued, but it's just because you're getting a one-of-a-kind company with a huge competitive advantage and one with a very strong brand and a loyal customer base. So this is a price to sales of 11. Normally, I would want the company growing, at least over 20% revenue growth, but with only 13%, I'm going to give this a no because that is still considered on the low side. Same thing with price to earnings, a 32 price to earnings with only 10% growth. That's a little bit less than I would like. Then we get to, is the company innovative? Do they have a moat? Absolutely. I think they're a very innovative company. Their software is very important. And what gives them their moat is their reputation, the number of customers they have, the number of products and services they have, and how reliant people are on their products. So these creators that, edit pictures, edit videos, or they use Photoshop, they use Illustrator, whatever it is, you're getting the best. You're getting the best brand in this space. You could get other services, but if you want the best thing, everyone is going to gravitate towards Adobe products, right? So that's their moat. They pretty much have a one-of-a-kind, product and service, and especially what their reputation is like. Then we have, is it a growing industry? Yes, absolutely. It looks like over the next 5 years, the freelancing industry is supposed to be growing at 15% a year. So definitely there's a strong industry there. And then this is incredible. This is insane. This is probably the highest return on invested capital I've ever seen. This is a 92% return on invested capital. That's insanely high. A lot of companies, could be anywhere from 10%, 20, 30%. A high return on invested capital is like 30% or 40%. Like if you can get a 40% return on invested capital, that's very high. But 92% is just insane. Then we have the same thing with margins. This is one of the highest margin businesses I've ever seen in my life. They do have healthy margins. They have an 88% gross margin and a 30% profit margin. That's some of the highest numbers I've ever seen. Healthy cash flow, yes. If we look at cash flow, we can see that they definitely are investing very heavily into this business. And after I read their 10K, it looks like they're really spending that money on research and development, and then marketing and sales, which most companies spend a lot of money on marketing and sales, but it looks like Adobe is spending a lot on research and development too. That's really their main costs. But if we go to cash flow, we can see here, operating cash flow is definitely strong. They're doing over $7 billion. They're investing billions and back into the business. It looks like, let's see, where'd this come from? So they issued, stock payment. So they issued over $5.4 billion of stock payments they issued, right? End cash position has come down a little bit, 2.7, and that's really seems to be because there's so much coming out of investing and financing, right? That's why that number is coming down. Then we have free cash flow of 6.8 billion. This number is growing, so that's strong. The free cash flow is really that's the important thing. There's all these different things where cash could be going in and out of, but free cash flow is the bottom line, tells you actually how much cash is moving in or out. That's the important thing. So that's going to get a check. Number 11, diverse revenue streams. Yes, they are a global business, so they operate in all the different countries, and think about the number of customers they have, millions of customers, and the number of products and services they have. It's not like they just sell one. Let's say they only sold Photoshop as their only service, well, then that would be a problem. That's just one service, right? But they have, a dozen different products that they could sell, and millions of people subscribing to their services every month. So that definitely a diversified business model. They have more assets and liabilities, so the balance sheet is strong. Price to book, I'm going to give this a no. This does not look good at all. This makes it look overvalued because the company is trading at 15 times their book value, right? I believe they have, I want to say, what is it? It's like 15 billion, 16 billion maybe in equity, and it's trading at a little over $200 billion of valuation. And that's also with 2% equity growth year over year. So not that great. So unfortunately, that's going to get a no. Is the equity over 10% of the market cap? How I just said, no, it's not. It's only 6%. That's not too good. That's definitely under what we're looking for. Is the equity increasing? Yes. So that's a good sign, but still, it just trades at a little bit of a rich valuation. Do they have a strong share buyback, or is there a dividend? Yes, the share change was minus 1% year over year. So they are taking shares off the market. And it looks like in the most recent quarter, they bought $2.4 billion worth of shares, which is huge. That's a lot. Are insiders interested? Yes, although they only own like under 1% of the company, which is very small. But keep in mind, 1% of this company is over $2 billion. So if you think about it, that is a decent amount. And then you can see over the past year or so, there's been a lot of sells, but there's also been a lot of buys. It looks like they were really buying up when it was around, $500 to $600. So I don't know. Maybe they're not. That we haven't. There has not been many buys though in the last month though. So I don't know. We'll have to keep an eye out for that. Maybe they're not that bullish. But finally, we have, is it founder led? No, not right now, not at the moment. How old is this company? This company is from 1982, right? So no, they're not going to be. The founders still not going to be there. But what we do have is a good management and a talented team. And how do I know that? Well, because look at the numbers. Look at their return on invested capital and look at their margins. That's really the important thing. Look at the reputation they have. Look at the number of customers they have. All those things are super important. So overall, this is going to get a 14 out of 18 because it looks like the only 4 they missed were the price to book, the equity percentage, and then the price to sales and price to earnings. Again, it's a magnificently run business with fantastic profit margins, competitive moat, and products and services, a loyal customer base, everything. It's great. It's 10 out of 10 in that case. But as far as valuation goes, does not look that attractive. But with some companies, like with an Amazon or with a Netflix, was the same way for a long time. Those certain companies that are just one of a kind, that are so big and that everyone knows around the world, those companies will often trade at high valuations, whether it's a PE of 50 or 60, price to sales sometimes of 10 to 20. Those are high numbers, but sometimes they trade at those high valuations. If it was just an average, let's say it was like a $10 billion company and it was like just a mediocre business, then these price to sales and price to earnings metrics would probably be a little bit lower, right? It would, if they were growing at 13%, the price should be half of what it is today. That's really the only reason it's this high. So would I buy it? I've always wanted to own this business. I was actually thinking about buying this. I want to say when it dropped to, was it right here? No, I think it was, I forgot where it was. Oh, it was right here. It was right here. So that was almost a year ago. Wow. When it was 480 last year, I remember looking at it and saying, I want to buy this right now, but I'm going to wait because I think it could go down a little bit more. Well, and then it ended up running up for the next 6 months and it went all the way up to $700. So I never bought it. And now it's even below that price. But I mean so if you look at the 5-year chart, it was trading, higher than this price almost 2 years ago now. So I honestly, I think $430 a share is a fair valuation for this company. I think this is where it deserves to trade. If it shot up more towards $500 a share, then I could say that's overvalued, right? Now, if it came down to 350 would definitely be an undervalued stock, and I would say that's easy money. But at this price, I'm not so sure. I'm not buying this yet. I'm not a financial advisor, so don't take my advice. But I mean, I think Adobe is a 10 out of 10 business and brand. It's going to normally trade at a rich valuation, it looks like, because it has that, competitive edge. But that's pretty much it for today. So thank you for watching. And if you guys have any questions about stocks or anything, comment down below and I'll answer. But I will see you in the next video.